When the chairperson of India's largest private sector lender resigns, citing values and ethics and nothing more, the system is not expected to have all the answers, but it is expected to ask the right questions. The institutional response to Atanu Chakraborty's sudden exit from the board of HDFC Bank suggests that we don't ask the right questions. In the hours immediately following his resignation on 18th March, both the HDFC board and the Reserve Bank of India took measures to calm the markets, but they offered little by way of factual explanations or clarity. This suggests a deeper problem with Indian corporate and regulatory governance, and that is the inability to manage ambiguity. Now, faced with this ambiguity, the popular discourse has come to perceive Mr. Chakraborty's resignation as a largely episodic, impulsive, and personal decision. But at characterizing this decision as a personal matter and a matter of interpersonal disputes between board members does not do justice to its seriousness. After all, at heart is the resignation of the chairperson cum independent director of India's second largest listed company, one whose credit rating often rivals that of the sovereign. In my finance and governance column in ThePrint this week, I argue that HDFC Bank board and the resigning chairperson owed it to the company's shareholders and the public to give more clarity on the reasons for his resignation. And second, the Reserve Bank of India owed it to the depositors and savers of HDFC Bank and the public to exercise greater caution before issuing what amounted to a governance guarantee for HDFC Bank. While reassuring the markets and the public in the face of panic on the financial soundness of a system and a bank is rather routine, offering a governance endorsement in the absence of clarity and facts is not. The sanguine treatment of the matter was priced in by the markets. Markets may not be great at pricing in ethics, but they do price in ambiguity pretty quickly. On 19th March, the day immediately following the resignation, the stock of HDFC Bank declined by a little more than 5%, despite the unanimous assurance of the board and the Reserve Bank of India that all was well. And this decline continued until HDFC Bank signaled a willingness to look inward by appointing two external law firms to inquire into the matter. On 18th March, HDFC Bank informed the stock exchanges of the sudden resignation of Atanu Chakraborty, their independent director cum chairperson. Now, on the one hand, this largely aligns with what independent directors' role is envisioned as. Independent directors are set up as institutional skeptics. They are supposed to be asking the more uncomfortable questions to the rest of the board members. They are supposed to be raising a stink when things get murky and align with the board when the board acts in the best interests of the company. In fact, if anything, there is a lot of critique of Indian independent directors that they are not sufficiently skeptic. Viewed thus and presuming good faith on the part of Atanu Chakraborty, his actions actually align with the role of an independent director. However, institutional skepticism is not an end in itself. Independent directors, like all other directors, have fiduciary obligation to the shareholders of the company. They're supposed to be responsible for the board oversight and also in such cases are custodians of public trust. In such cases, therefore, an exit on the ground of values and ethics is not a routine exit. It signals something serious. The fiduciary obligation of a director in such a case does not stop at just exit. It extends to disclosing to shareholders what exactly happened, what are the concerns, what measures were taken to address those concerns, and whether those concerns still persist. Now coming to the board's management of this ambiguity. On the morning of 19th March, HDFC Bank organized an investor call. The directors present on this investor call did not offer any new facts or any new information explaining the sudden resignation. In fact, they emphatically insisted that there was nothing wrong on the governance front. They relied on generic language such as the robustness of their internal governance and controls, using generic corporate speak to explain what was a rather extraordinary event. For example, Mr. K.K. Mistry, who was appointed as the interim chairperson on the board, insisted that his acceptance of the appointment at the late age of 71 should by itself signal that all was well on the governance front. In some, HDFC, through this investor call, tried to portray the sudden resignation as a matter of interpersonal disputes between the board members and tried to frame HDFC board as the victim of a disgruntled independent director. In fact, it ended up creating more opacity rather than a willingness to look inside and to look inwards and inquire into the matter. The markets priced this in. On the same day, the Reserve Bank of India also issued a press statement offering reassurance on the financial soundness of HDFC Bank. Now, this is rather routine for banking supervisors because the business model of banking is rather fragile. It involves converting short term deposits into long term loans, and banks are especially vulnerable to runs in the face of panic. However, the Reserve Bank of India's press release stood out not for its guarantees on HDFC's capital adequacy, liquidity coverage, etc., but for what was effectively a governance endorsement despite the resigning CEO's explicit concerns on values and ethics. The RBI's press statement stated endorsed HDFC Bank for its professionally run management and competent board. And the RBI also certified that nothing material had on the governance front had shown up in any of its inquiries and investigations. Therefore, what it effectively offered was an endorsement of HDFC's governance despite the ambiguity. There was no language suggesting that they were looking into the matter. There was language suggesting that they had explicitly interacted with the board, but nothing on whether they had actually asked the resigning director for the reasons for his resignation. And in fact, this was a person who was deemed fit and proper by the Reserve Bank of India to be appointed as the chairperson and independent director of HDFC Bank. And despite the professional and reputational costs that such a resignation would have entailed, Mr. Chakraborty took this step nevertheless. This by itself should have invited scrutiny on the reasons for resignation. Now, compare RBI's response to this sudden exit to its response when the CEO of RBL Bank, Vishwahir Ahuja, suddenly exited in 2021 on medical grounds. When this exit happened, RBI similarly issued a press statement with a tightly worded guarantee on RBL Bank's financial soundness, but nothing on governance. In fact, it ended up appointing an additional director when the CEO of RBL Bank suddenly exited. A review of the sudden exits of CEOs of foreign banks ranging from HSBC to Barclays shows that while banking supervisors often offer guarantees on the financial soundness of the system, and in exceptional cases, even the financial soundness of a specific bank, they explicitly refrain from offering a clean sheet on governance, especially when the facts are so ambiguous. Atanu Chakraborty's sudden exit from the board of HDFC Bank, citing values and ethics as concerns, will likely go down in corporate folklore as a legend, second only to Ramalinga Raju's exit from Satyam in 2001. However, the institutional response to this sudden exit will most likely be forgotten. And that's unfortunate because it is this response that holds lessons and insights for India. When faced with uncertainty, institutions reveal their instincts. In the face of ambiguity, India's instinct is to reassure first and investigate later. Now, while this may calm markets temporarily, it does do long-term damage to the credibility of the company itself and of the regulator as well. The real test of governance is not how institutions act when facts are clear, but how they respond when they are not.